Hey, I'm Casey Chauhan, and in this video, we're going to dig into the 4 main structures that you need to know about. We're going to be comparing LLCs, S Corps, C Corps with my personal favorite, the private family foundation. And you're going to understand why all billionaires have a foundation at the end of their structure, how they use it, and what the benefits are of that structure. So stick around, we're going to go through it line by line. Let's get into it. So, most people will start their business with one of 3 initial structures, right? There is a potential 4th, but we'll get into LLCs, S Corps, and C Corps. They're the main 3. And then occasionally, if you're starting a smaller business, or if you're doing something that's really small, then you could potentially do a sole prop as well. Now, there's a lot of reasons why I don't recommend you do a sole prop. The main thing is the liability involved. You could easily get sued, and they could take all your personal assets. So unless you're doing something that doesn't really involve many external people, maybe something like trading, then maybe that would be okay with a sole prop. But generally speaking, the majority of people will pick one of these 3 structures: LLC, S Corp, and C Corp. And depending on your level of wealth, I'm going to show you exactly why you do not need any of them. And all billionaires have one structure in common, and we're going to go over that a little bit later. So stick around for that. So let's start with the types of tax structure. The LLC and the S Corp are both very similar. They have something called pass-through taxation. So whatever profits are made at the entity level get passed through to the owners, whether that's shareholders or members. The S Corp has shareholders, the LLC has members, and then profits are then paid by those people. The C Corp is slightly different. It has double taxation, both at the corporation level and then at the ownership level. So this is why most people do not use C Corps. The main reason people do use C Corps is if they're raising funds. Technology businesses, as an example, if they're going to seed fund rounds, they will likely use a C Corp because you can have more investors in a C Corp and you're not limited in that way, but you are limited in other ways. But my favorite structure of them all is called a private foundation. This is the 4th option, right? And that is a tax exempt entity, so it has no taxation, and that is a 501c3 private foundation, and you get that exempt status directly from the IRS. Okay, next thing, property tax. Okay, when we look at a property tax, it varies state to state. Here in California, it could be as high as 1.5%, 2%. In other places, it's 0. So across the United States is a broad spectrum. Generally speaking, LLCs, S Corps, and C Corps are all going to be the same in that regard, that they're going to pay that range of, let's call it 0 to 3-ish%, give or take. Whereas if the private foundation has a piece of real estate and it's paid off, you can have 0 property tax. That's right, you can pay 0 property tax if the conditions are met that the foundation owns the asset, i.e. the real estate, and that it is fully paid off. It has no mortgages. So if you meet all the conditions, then you can apply for the exemption for property tax. Right, next up, salaries. In an LLC, a salary is not required. In an S Corp, it is. You have to pay yourself something called reasonable compensation. What is reasonable? Sometimes there's a little bit of gray area in what is seen as reasonable, and people do push those boundaries. So depending on what the profession is, how many hours you're working, and so on, other factors, you should take a reasonable salary at least once a year. Then in the C Corp, it's the same. You should take a reasonable requirement for salaries. And then in the foundation, there's no requirement for this. So LLC and foundation win in this one because there is no requirement. S Corp and C Corp, it's the same. You have to pay yourself something. Now, the next one, life insurance premiums. So you can deduct in certain circumstances in an LLC, an S Corp, and a C Corp, a key man life insurance policy. It's very, very specific. It's very nuanced. But in that case, if you have a key person that works for you in the company and you then insure them, you can take that as a tax deduction. Again, speak to your CPA about this. Make sure that it is a key man. The policy is right. You're meeting all of the right regulations because it's very key. Most insurance is not deductible in those regular entities. And if you start deducting it, you're going to get yourself into trouble. So make sure you do have a key man policy because that is a good tax deduction that you can take for those key people. Now, in the private foundation, all of that is deductible. All insurance policies are deductible because you're in a tax exempt entity here. It's a very different set of rules that play in the foundation compared to the regular business structures, right? So life insurance, whether that's insurance on buildings, things like that, that's all deductible deductible in the foundation. Next one, charitable contributions. In an LLC, depending on which charity you donate to, you can get from 30 to 60% deduction, and that is for both the LLC and the S Corp, both the same. 30% private foundation, all the way up to 60% in a donor advised fund. Just depends on how you're structured, what you're wanting to achieve. Make sure you speak to a professional about that. In a C Corp, you can deduct up to 10%. So it's very different rules in a C Corp than it is to an LLC and an S Corp. So again, depending on how you're structured, you could take 10% and get a deduction for that, or you could get up to 60% in an LLC or an S Corp. That's straight savings if you know how to then operate the foundation correctly, because the foundation gets 100%. So you got to really know your structures to see how much can you afford to donate to charity, and then what's the maximum percentage you can get depending on the structure that you're in. Really important. Okay, capital gains. When we're looking at capital gains, it's very similar here. So you've got state and then you've got federal. Again, depending on which state you are in, it will vary. Some states have 0, some states have 10, 12%, right? And then on top of that, there's the federal. So you got a 20% hit at the federal level regardless, 21% in a C Corp. So the LLCs and the S Corps will get a state and federal combined. If you're in Florida, Nevada, certain states don't have that. But in California, you got 20% federal and then another 9%, 10% at the state level. So you're talking 30+% of capital gains if that's long term. If it's short term, it's even higher. So it's really important to know how you're going to structure yourself for capital gains, because there's no capital gains in a foundation. If a foundation owns an asset and it appreciates in value, you do not pay anything in capital gains tax. It does not exist in the foundation. There is something different we'll get into in a second, but that's only 1.4% net investment income. Okay, we'll get into that later. All right, next. Estate tax. So estate tax is a little bit high right now. It's crazy. The thresholds did go up a few years back. So now anything over 13 million gets taxed anywhere from 18 to 40%, regardless of LLC, S Corp or C Corp. But again, in a foundation, there is no such thing as estate tax. It's totally eliminated. So if you structure your foundation correctly, whereas your heirs take over that foundation upon your demise or whenever you feel necessary, there's no estate tax, there's no capital gains tax, there's potentially even no property tax. So you're starting to see the picture of why the foundation is the best structure to be in. Investment profits. Okay, so LLC, S Corp and C Corp are all very similar when it comes to income and creating profits. So ordinary income rates apply across the board to those guys when they're making passive investments. However, in the foundation, there is a small tax here. Now, it's only a small one. It's 1.39% of net investment income. What does that mean? If you go invest $100 in a stock, let's say, and it appreciates, you only pay on the appreciation, right? You pay 1.39%, which shouldn't really be an issue. It's minute compared to the other entities, right? And it's the same for business income. When you have business income come into an LLC, S Corp, C Corp, depending on which state you're in, you're going to have, and how much you make as well, because it's a tiered system, remember. You're going to pay a lot more. Usually the people watching this are making 7, 8, 9 figures in income. You're going to be in the highest brackets, which are going to be well over 30-ish%. In a private foundation, if you have UBI, is what they call it, unrelated business income, because it's unrelated to the foundation and the mission of the foundation, then you're capped. You only pay 21%. So most people would swap that out instantly anyway, because it's a lower percentage. But you've got to know the difference between investment income and unrelated business income. These are the two main ways that you get taxed in a foundation. The investment income is a low tax at 1.39, and the unrelated business income is taxed at 21%, which is slightly higher, but it's still usually less than most people are paying already. Now, the next piece is the legacy. In a business, regular business entity, LLC, S Corp, C Corp, you're very limited on legacy because you will get taxed at probate when you either distribute or when you sell your shares or membership. You're going to get crushed. With a foundation, it's set up in a way, when done correctly, that it's multi-generational. So this is really you creating your lasting legacy so that you can pass on those assets to your children or your heirs so that they can make a bigger impact in the community. They can reinvest those funds, buy more assets, do more good, all in the name of the family legacy. So that's really important. Then the last but not least is family involvement. Usually in LLCs, S Corps and C Corps, Corps, families are only involved from a business focus, right? But in the foundation, there's no limit to what they can do. They can clean the floors, they can do surveys, they can do reports, they can be on the board, they can be in all the board meetings, taking minutes, treasury. There's so many different roles that you can teach your children the values of what it is to create a legacy and literally transfer the thoughts and the mindset of how you think into your children. And that is how the elite families all do it. So thanks for sticking around to the end of this. If you've liked this video and you want to learn more about private foundations, hit the link below. Join our free school community where you can ask us any questions you like and how to set up this type of structure for you and your family.